Managerial accounting provides information for insiders. Insiders are management and high-up employees who have access to the company's financial information. They're the people who direct and control the business of the company. Financial accounting, on the other hand, is really devoted towards the interests of external users of financial accounting information. And these are folks like shareholders, creditors, certain governmental entities, unions, and financial analysts, for example. So these two types of accounting are oriented towards two very different groups of users, and as a result, there's some really substantial differences between these two types of accounting. The first set of differences really comes about because of the orientation towards those different decision-maker user groups. Management accounting doesn't have any rules. It's really evolved from the best practices of managers working within their own companies. It's really a compilation of best practices, most efficient ways to solve problems. And as a result, I think it's actually a lot more fun than financial accounting. It's very practical, very common sense approach to problem solving. Financial accounting, on the other hand, is dedicated to the purpose of providing good financial information to external users. And as a result, we really need to protect the interests of those users and make sure that they're getting high quality information. Therefore, financial accounting is legislated and governed by regulatory agencies and professional institutions. Financial accounting is very rule-based. As you'll recall, we have this body of rules around financial accounting called GAAP, Generally Accepted Accounting Principles, and financial accounting really was learning and applying the rules of GAAP. There's also a really big difference in the purpose of these two types of accounting. Management accounting exists to serve the competitive needs of organizations that must constantly plan, control, and evaluate their operations. Financial accounting, on the other hand, exists to serve the need of the organization to periodically report its results to outside investors and lenders. There can be overlap, and certainly management uses financial accounting information a lot. It reviews it all the time because it has to before it releases it to the public. But because of this difference in purpose, managerial accounting requires a lot of different information that's above and beyond the information that's gathered for financial statement purposes. As a result, we have very different outcomes from doing these two different types of accounting. Management accounting results in both financial and non-financial data that's proprietary in nature. In other words, it's guarded from becoming available to competitors and the general public. Management doesn't want their competition to have this amount of detailed information. Financial accounting results in only financial data, and it's public, and it's going to be reported to the investors and the creditors. So I hope you can see that these two types of accounting are very, very different by nature. This little piece of clip art is supposed to represent Icarus. Icarus was a mythological character who had paper wings, and when Icarus flew too close to the sun, well, you can guess what happened. It wasn't a pretty ending. I want to stretch this analogy, maybe a little too far, to financial and managerial accounting. Financial accounting really has given you paper wings. It's very useful information, and hopefully it will benefit all of you in your lives and your careers. However, just knowing financial information and not having any background at all in managerial accounting can be a very dangerous thing.
The rest of the course, then, will be focusing on managerial accounting. As usual, before we can get very far, we need to spend some time just on definitions. Our first definition is just cost. Managers must understand a variety of different cost concepts. Here's a basic definition of a cost. It's what you give up to acquire something else you need for a current or future benefit. We're going to spend some time categorizing costs in many different ways, and I'll show you a chart of those in just a moment. For now, though, here's an example. In financial accounting, we basically categorize cost many ways already. One way was to differentiate between unexpired costs and expired costs. Unexpired costs were costs that were going to provide benefit beyond the end of the current accounting period, and we called those assets, whereas expired costs were expenses on the financial statements. Here we'll be looking at several other classification schemes for costs. We'll start out by defining direct versus indirect costs. We'll then discuss manufacturing versus non-manufacturing costs, product versus period costs, and prime versus conversion costs. All of these classifications are going to help us understand how to put together financial statements for manufacturing firms and how to use costs for better decision making. In the next unit, we'll expand our classification system a little broader, and we'll have some classifications that take into account how costs behave. For now, though, let's define one other term, cost object.
One important purpose of managerial accounting systems is to be able to assign costs to cost objects. Cost objects can be anything that you want to assign cost to, so it could be a product, that would be a very common cost object, or it could be a department, assembly versus finishing. It could be just a particular project or a particular activity, customer service. How do we actually do this? Well, it depends on the type of cost, but the way we assign cost to cost objects is one of these two ways. We're either able to trace them directly to the cost object, and that would be something like, let's say you're a manufacturing company and you are producing hula hoops. You should be able to directly trace the cost of the plastic, the raw materials that goes into those hula hoops, to the product that you're producing. If you can't trace the cost, then you need to come up with some reasonable, rational way in which you allocate the cost among your various cost objects. And that leads us to another way in which we're going to classify costs. All costs can be classified as either direct or indirect. Direct costs are those costs, like raw materials, that can be easily and accurately traced to a cost object. Indirect costs are everything else. Indirect costs are generally things that are common to several cost objects, and so you can't trace it to any particular cost object. Or alternatively, you might be able to trace it, but the cost is so small that it's just not worth the effort. Let's say we have a manufacturer that manufactures two types of stuffed animals, bears and frogs. Many of the costs of producing those toys are going to be directly traceable. You'll know what fabric you used on the bears versus what fabric you used on the frogs, for example. But let's say that there's one manager of the entire factory facility. The salary of the manager for the facility would be an example of an indirect cost. That manager oversees the production of both products, so his or her salary would be indirect with respect to the cost object, which in this case would be the product line. Another example of an indirect cost that fits the second bullet might be the cost of thread. It may be possible to figure out how much thread goes into each bear or each frog, but if the cost of the thread is so small that it wouldn't affect anything, then nobody's going to bother to try to assign the cost of thread between the two products. Instead, they'll end up just allocating it in some way. Here's another example. Assume 7 of us are hungry, so we go out for pie and coffee. We order 7 drinks. Everybody's got different beverages, different types of coffee, and we order a whole pie that we're going to share. Think for a minute about those two groups of costs, the drinks and the pie, and think about whether the costs would be classified as direct or indirect with respect to each one of us that's sitting at the table. Well, think about how we would split the bill. The bill comes at the end of our snack, and we're each going to pitch in. It would be pretty easy to directly trace the cost of the drinks. Sitting, on that receipt, there's going to be each one of our drinks listed, and we'll know exactly how much it cost. But what about the cost of the pie? The cost of the pie would be an indirect cost because it was common. It needs to be allocated among the 7 of us. How would we choose to allocate that cost? Well, in accounting, you can use any reasonable or rational method. Here, the simplest way, the most obvious way, would just be to divide up the cost of the pie 7 ways. We could get trickier. We could measure the circumference of each slice of pie that each of us ate. If you ate slice that's on the plate, and I ate the really gigantic slice, then perhaps I should pay more than you. We could also use some sort of indirect measure. We could, figure out what everybody weighs and then allocate the cost of the pie in proportion to the weight of the diner. That would be an example of using, some other cost driver, something that you think might have a causal effect when you can't measure the use more directly. Here's something that's important and easy to miss about direct versus indirect. Direct and indirect have to be defined with respect to a cost object. In our pie example, we've been talking about, is the cost of drink or pie direct or indirect with respect to each diner, to each person? The answer could change if we redefine the cost object. Let's redefine the cost object to be each table of diners. Now, is the cost of the drinks and the pie direct or indirect with respect to each table of diners? Well, obviously, the cost of the drinks are still direct, and now the cost of the pie has also turned into a direct cost. It's very possible to trace 100% of the cost of that pie just to our table. When you're trying to determine if a cost is direct or indirect, just think about, can it be traced or would it have to be allocated, considering the particular cost object. For manufacturing businesses, one of the more challenging aspects is to determine the cost of products, to do product costing. One thing I want to just mention right now, and we'll come back to this later, is that in managerial accounting in particular, we define costs differently for different purposes. So as far as product costing goes, right now what we're talking about is product costing for purposes of external financial statement reporting. We want to be able to determine product costs so that we can assign a dollar cost to inventory on the balance sheet and a dollar cost to cost of goods sold, the expense that shows up on the income statement. Product costs for purposes of external reporting will not necessarily be the same thing as product cost for purposes of determining what you want to sell your product for example. For external reporting purposes, we use a functional classification of costs. All costs are divided into one of these 2 categories, manufacturing or non-manufacturing. For this purpose, product costs and manufacturing costs would be the same thing, and period costs and non-manufacturing costs would be the same thing. Manufacturing costs are synonymous with the term product cost because under GAAP, all manufacturing costs must be inventoried. They must be attached to a product, and they don't become an expense until the time at which they get sold. What I've just described is a classic example of the matching principle in financial accounting. We can't recognize any costs that are related to the cost of manufacturing a teddy bear until the accounting period in which we sell the teddy bear. If we do that, we'll match our sales revenue and our cost of goods sold together properly. There are 3 types of manufacturing costs: direct materials, direct labor, and manufacturing overhead. Non-manufacturing costs are also called period costs. That's because non-manufacturing costs are all deducted in the accounting period in which they are incurred. So these things never hit the balance sheet. They go directly to the income statement as an expense in the proper accounting period, the period in which they were incurred. So here are our three types of manufacturing costs again, and all three of these types of costs get capitalized, get inventoried, get put on the balance sheet as an inventory cost, and that's why they're all considered to be product cost. Direct materials are the materials that become a part of the product, and they're called direct materials because it's very easy to trace the cost of those materials directly to the product. Direct labor is the cost of labor needed to convert the raw material into a finished product. So the cost of salaries. It's often called touch labor. This is the cost of labor of those individuals that are actually touching the product. And manufacturing overhead is everything else. All other manufacturing costs that don't qualify as direct labor or direct material get stuffed into this category, manufacturing overhead. By its nature, manufacturing overhead are costs that can't be directly traced, so we'll need to figure out a way to allocate them to the products or cost objects. Manufacturing overhead would include depreciation of the factory, utilities, rent, maintenance, supervision, security costs, all of those types of costs in the factory. It would also include the cost of supplies. Supplies that go here are those supplies that are necessary for production, but the supply itself does not become part of the finished product. So for example, if the company is building lamps and once they're done building them they use a buffing cloth to remove the fingerprints, the cost of the buffing cloth would be considered a supply. It wouldn't be considered direct materials because it did not become part of the lamp. Two other common categories of manufacturing overhead are indirect labor and indirect materials. The salary of that production manager that I used in an early example, where the manager was supervising the production of both stuffed bears and stuffed frogs, that would be an example of indirect labor. The cost of the thread that was used on the bears and the frogs, because it was insignificant, that would be considered an indirect material. We can take these three manufacturing costs and classify them also as prime costs and conversion costs. Prime costs are the cost of the direct materials and the direct labor. Conversion costs are the costs of taking the raw materials and converting it into a finished product. So once you've got the raw materials, the other two costs that you need to add are labor and overhead. So those are the two conversion costs. Non-manufacturing costs, remember these are also called period costs. They're basically selling and administrative costs. Here's a reminder for you that product costs are all initially capitalized as inventory on the balance sheet. They only hit the income statement when they're sold, because at that point the costs become cost of goods sold. Period costs are expensed on the income statement as they are incurred.